So I want to wish everybody a good morning. I hope that we had some sleep last night after the craziness. The world's changing, isn't it great? Whenever there's change, there's business. People are upset, people are confused, and that kind of bodes well for all of us. So as long as we can stay on top of the changes, we'll be very happy. Thank you for attending the LAFPN meeting. We're very honored today to have as our guest speaker, Max Krotman. Max is one of the leading people in the United States that does mergers and acquisitions for accounting firms with Global. And with no further ado, Max, take it away.
Well, I'm here at the airport, so if it comes out wrong, I could hop on a plane and go to Venezuela or something. Neil wanted something to distract everybody for an hour so they wouldn't be worried about what we won't know till Friday anyway. So here we are talking about what's new in accounting or what's happening in accounting, and how does COVID affect accounting? And I'm sure everybody in accounting knows that COVID has changed, how we operate our practices, because we have a lot of people working remotely, including ourselves. Changes the office setup, and for the better, it changes client contact, where fewer clients come into the office to do a $300 or $1,000 tax return. So that has changed the nature of practice, I think permanently, because people will be trained by May, after 2 seasons of COVID, not to come into the office, and they find out it's pretty good. Will that diminish client loyalty? Yeah, maybe, but in the short run, it makes us all more efficient. And now we can do fewer interviews. What's happening in the merger and acquisition end? Well, the accounting population continues to age. There continues to be a shortage of staff. There continues to be a slow pace of retiring accountants. The world seems to think that now there'll be a lot of accountants retiring because they could see the handwriting on the wall. But seeing the handwriting on the wall is not sufficient to make a tremendous flow of accountants. How does this affect the deals? Well, firms that are looking to add business, and many are looking to add business because they've lost business, and firms which can get staff are doing everything they can to acquire practices. It's a good time to acquire a practice, but it's still hard to find the practices and coax the accountants into retiring. I've done half a dozen COVID-related deals. They're awful. We of course do them and help out the widow, but my God, they're no fun. I'd much rather deal with a recalcitrant accountant than an ignorant widow. Also, how do you do introductions and transition when someone has passed away? 3/4 of the deals we've been successful with getting transition and retention, but everyone has to work their butt off to make that happen. What's happening in multiples? That's usually the question buyers and sellers ask first. And my feeling is that multiples have reduced. So if they were 1 to 1.5 2 years ago, with a lot of 1 1/4s. I'd say they're now 1 to 1 1/4, with a lot of 1s and a lot of 1 1/4s. How do you determine what the multiple is going to be in a given deal? It's always, and by the way, and anybody can interrupt here. This is not, you know, the Pope ex cathedra. This is I'm going to give a short presentation and then open this to questions. But if you have any question or comment or thought, or you're still awake, then feel free to interrupt. It's not an interruption. It should be a dialogue, not a monologue. So the multiple is determined by how much the buying firm or the merging firm can make from the practice. So if the merging firm can make 40% of the gross of what it's bringing in a given year, then it can pay 20% of the gross to the selling accountant. If you pay it out over 5 years, that's a one-time multiple. If you pay it over 6 years, that's a 1.2 multiple. If the buying company is only making 25%, that's not so good. So how much can they pay? 12.5%. It's not going to be a makeable deal probably. Now, most of our deals are mergers into sales. So the selling accountant stays for 1 year, 2 years, 5 years, and makes money. Normally, he'll want to make what he was making before. So if he was making 40% before, he's going to want to continue to make 40%. Then in the process, the 73-year-old accountant may say, you know what, I've been making 40%. I want to continue making 40%, but I don't want to work 2,200 hours anymore. I want to work 1,500 hours. Aha! Now he can make less money. The buyer can make some money out of it, and the merger starts to be effective. The buyer makes more money if he can save on the cost of running the practice. So he saves on the cost by merging it into his office. He saves on the cost by using staff more effectively. He saves by using one software system. That's usually not 100% savings because he has to pay something more for his licenses, etc. He makes money by having one reception, although often a selling accountant or merging accountant will want to bring his number one office manager who makes $93,000 and has been with him since before World War I. Those are always a problem, but that's what comes out in these negotiations.
But Max, to interrupt for a second,
Sure.
that office manager has tremendous value during the initial transition period, probably more valuable than the accountant.
Well, I would disagree that they're more valuable than the accountant.
You know what I mean?
But if you did a deal today, normally we're going to keep that 93-year-old person through May.
Right.
Whether we keep them after May or not, several times I've done deals where that's the deal. We're going to keep Lula through May, and then Lula does turn out to be terrific, and the firm keeps Lula and gets rid of Dorothy. But yeah, the Lula person often is a quid pro quo for doing the deal, because often the accountant thinks that she's as valuable as you say she is, and he won't do the deal without her. And that has worked several times, even without what looked like a not particularly well qualified person who now had a longer commute. but she makes the commute. She learns more. She does some bookkeeping in addition to whatever the heck she does, and they tend to stay. Uh, I don't have a. I never did an article on that. I never wrote on that, but it is remarkable how often that apparently overpaid person, I shouldn't say overpaid, very well paid person, is maintained by the new firm. Uh, the multiples change depending on who the buyer is. Uh, if 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 someone is a sole practitioner and he can bring a practice in, pick up uh, the extra work himself, or a lot of the extra work himself, he can pay a higher multiple because his costs are going to go down in running that practice. And so you tend to see um, a practice go for a higher multiple to a smaller firm than a larger firm. If it's a $20 million firm, they're very limited in how much they can pay because they have cost in starting a client up. They have a cost in the low level person that does the initial entries. They have a cost in the reviewer or the manager that's overseeing the people below, and then the partner's got to take a look at it. So the product should be very good, but you got 3 layers of people where in a small firm, the partner does the whole thing and no one reviews it. That's one guy's time. So the profit level on a new business is less than it would be for a sole practitioner who doesn't need the 3 levels and saves money. So when you're selling or you're buying and you're a bigger firm, the multiples tend to either be lower or the payout much longer. So someone might buy a practice and again pay a 1.2 multiple, but pays it over 8 years. So at over 8 years, they're paying a manageable percentage, and of course, that's a two-edged sword because if the deal is on collections, which almost all of our deals are straight collection deals, then you tend to clients die and you lose them, and then you don't pay on them. So the seller doesn't get as much in the long run for his 90-year-old client as he does for his 30-year-old client. But on the other hand, the larger firm can add services that the smaller firm can't have. It can raise rates, and it could be over the long term. The seller makes more money than if he did it over the short term.
Hey, Max, how much of a role of matchmaker do you play? Like, do firms come to you and say, hey, I'm looking to merge with somebody and, I'm looking to seed my business, and then you help find them a partner or a willing suitor?
That's what I do. I would say most of the deals we do are people that we have talked with for 5 to 20 years. Now it's even getting more intimate because having been around for 25 years, we have clients who bought 1, bought 2, bought 3, bought 4, and now it's time for them to sell. Unfortunately for me, in the time of COVID, I still feel it's necessary for me to sit down and talk with the seller. Unfortunately for my health, up until now, I've been meeting the new sellers or someone who's ready to sell outside. Today I could still do it, but I'm not sure. Well, I'm not going to meet many people January, February, March. For January, February, March, people don't say, oh, it's time to sell. So that's a roundabout answer to your question. Yes, it's very much a matchmaking situation. It's matchmaking on 2 levels. One, you can't sell a firm that has $200 tax returns to a firm that does $500 tax returns. That is not going to work. You could sell a firm with $300 or $400 tax returns to a firm that does 500 because they can raise them up, and you know everybody will make out. They raise them up slowly. You lose some clients, but you gain more revenues, and everybody can make out. So when we put together an introduction, we first send out a 2-page prospectus that tells the firm what the hell it is the client does, and we match them up economically and professionally and geographically. So that's part of the matchmaking. The other part of the matchmaking is the personalities. So Lord knows I'm not a personality expert, but I've gotten better over the last 25 years. And we've been able to introduce people where, let's say a seller is going to meet 5 people, where he meets 5 people that all fit economically, all fit professionally, and have a good start at being a personality fit. If we're right 60% of the time, then that's very good. But we try not to be at the first meeting, because we want the people to be themselves, not be guided, and either have a good personality mesh or not. At the first meeting, they don't negotiate price. They talk about what the practice is. So if I've told the buyer it's a $300 tax return and the average tax return is really $200, that comes out at the first meeting. And then we see if there's a fit. And all kinds of ancillary things come up, like often the buyer has access to financial planning and the seller doesn't, or doesn't believe in it. And so that becomes an added profit factor. The seller may not do audits, the buyer does audits, they can pick up audits. Nobody wants to do peer review anymore, so that's a good reason to sell your practice, just have to avoid peer review. But every practice is unique. Every accountant will tell me my practice is unique, and they're right. They're right because 1, their clients are unique, and 2, they're unique. So the people that stuck with this guy, they're trained in a certain way and are comfortable with that. So we have to
Hey,
find
Max.
somebody. Yeah.
Matt, this is Scott Cheslowitz. May I ask you a question?
How do you do, Scott? Pleased to
How
meet
do
you,
you
even
do?
if I can't see you.
Yeah, you should be thankful for that.
I thank you.
Anyway, in a couple of situations, we were looking to buy practices, and they didn't have liability insurance. And it was, yeah, I mean, what do you do when you find those situations?
Not your problem.
What firm are you with, Scott?
Rothenberg and Peters, PLLC, in person.
Oh, wow. Well, what do? You're not liable for their past sins.
Mhm.
So that's the legal answer. They got away with it. They're lucky. What's the downside? The downside is 2 years from now, when the
Yeah.
client sues you, and nobody can buy a tail. There's no tail available to buy for these
That's
people.
right. That's
So you
right.
can't buy, your insurance won't cover you, etc. So 2 years from now, they sue you for a current malpractice, and they say, well, you've been doing my tax return wrong for the last 15 years, so you owe me X amount of dollars. Then when you go to court, you gotta prove, well, the 3 years before these here, we had nothing to do with. Well, here's what we'll do with you for the last 2 years, or we'll fight the whole thing. Has not come up in any of my deals in the last 25 years.
Scott, I think
Yeah,
it's part of-
I'm sorry, I'm concerned about the legal fees and the arm twisting to get you to settle in a situation, but it has not come up. I'm sorry, who did I interrupt?
Scott, it's Larry. How you doing?
Hey,
But I think it's part of any deal, though, that you might undertake, you would require the guy merging into you to purchase tail from day one, and that's his responsibility.
But they
Well,
can't,
Larry,
they
he
don't
can't
have-
buy tail.
they can't. They
it's not
can't.
market.
Yeah, they're
Larry,
not
if
in
you
the
don't have
market.
the
They
body,
can't.
if you don't have a body, you can't buy a tail. So you
But
can
you
chase
do
a tail
have to-
all you want, but you can't get one in insurance, as far as I know. I'm sure there's somewhere where you can get it, but
Yeah,
no one that I've
shake my hand, you're insured.
Guys, I think the answer is on your legal documents. This is Larry Shearer. You're going to put indemnification provisions in. You're going to spread out the payments to make sure that you're buying from proceeds, and it's going to affect the proceeds in the future returns to you if you get sued and you have to cover, settle, or do anything else.
Yeah,
Yeah,
Larry, we thought about escrow and things like that, and there's always the concern about nobody sues for $10 and the legal fees, and
Exactly.
how much it's so. All right, I'm sorry to interrupt, but that was
No,
the
it's a good
concern
question.
we had.
No, that's
Thank
one
you.
concern.
Scott, every agreement should have a provision that the seller indemnifies the buyer for
Sure.
any of his stuff, including legal fees. So that would that's if you got a 5-year or 7-year payout, you have some protection. If they're suing
Right.
him for $7 million, you don't have protection.
Yeah.
But if it's $7 million, it's probably going to be something where your lawyer will get you dismissed as to the prior years, and really, you shouldn't be committing malpractice for a couple of years before you get sued.
Yeah. I got to make a note about that. Thank you.
Okay, Scott. Tell your partner, Scott. I'm sure it's not you.
No. I'm going to spread the
I have a
word.
question.
Max, I have a question.
Sure.
Okay, Max. So once in a while, I've seen some deals where the sticking point is unfunded pensions, unfunded buyouts of the other partners. This is obviously larger deals. How do we address that?
That's not uncommon, and it's the payout to the firm includes their liability to the old partner, and so you assume that liability. The buyer essentially assumes that liability, but that becomes that should become a priority over the payments to the existing partners. I have not had that come up as a problem, but it could be a problem if the retired partners are overpaid, the business is gone, then they may have to do something else entirely. They may have to abandon the firm and just separate and then come to the firm individually and let the firm go bankrupt. Fortunately, I haven't had that happen, but that could happen if, let's say, junior partners are given a bill to pay the senior partners, which is outrageous, and that has been done.
Yeah.
Gary, you're smiling. You think that's funny?
No, because I've gone through this before. Max, my question for you is more generated to what industry do you see firms moving more into deals on? An accounting firm having a specialty in what industries?
Well, not restaurants.
It's my belief healthcare is still the big bang.
It depends on the accountant. Whatever he can do profitably. If you have a $50,000 client, which isn't all that profitable because it's labor intensive for the partner or labor intensive for a highly paid manager, that's not as good as a practice where you're doing a lot of bookkeeping and you can hire bookkeepers and you can make money, and the firm does the tax work also and makes money on that. But you're better leveraged. Now you make less money on bookkeeping than you do on high-end counseling, but high-end counseling, you have a very finite group of brains that you can buy or apply. So sometimes a very good client, so you got $100,000 client or a 500,000, how transferable it is, how serviceable it is, that depends. It's not an answer. I got somebody with a $500,000 client. We're doing a merger, but it's very well leveraged. So that's gonna work out very well. But I got somebody else who requires a ton of time from a partner, and that partner is going to retire, and then who the hell is going to do that work? Go to all these meetings and hold their hands and this and that. It's not easy. So each practice is unique, and it's when you match make, you have to see what the match is. Do you have let's say somebody comes in and they've got a lot of forensic work. Well, how many accountants can do forensic work? They all say they can do it, but not many can, or can do it properly. And so you have to match that firm up with a firm that has a forensic arm, which can handle it. Then you have a good fit.
Hey, Max, question for you on who is potentially acquiring some of these practices in any of your deals. And I know you work on some of the smaller deals, which might make it sense also. Do you see any younger professionals, people in their mid-30s, looking to go out on their own and acquire a practice to jumpstart themselves? Because we're having trouble, obviously, attracting that level of talent. And, that age.
Apparently, from the ages of 25 to 40, nobody was born, because they're just not out there. Now, I'm closing a deal this week with two of these young guys, and they're coming into a $5 million firm. They're going to be the successor partners. That's everybody's dream. Everybody calls me and asks for that, and I wish I had a reservoir of 35-year-olds. And
Everybody does.
the 15 years ago, if I brought somebody named Ahmed Patel, or nobody would talk to him. Now, okay, where did he go to school? What's his background? What's his client base? It's an interesting development. So no, they're not out there. What I do when I get them because they've been working at one of the medium-sized big firms, and they have something of a book of business, and they want to go out on their own, and I don't get many of them. I have a guy like that at a good firm, and he was making $250, and 2 years ago I could have gotten him really what he wanted and brought him into a firm, but the firm figured that out. So now they're paying him $450. At $450, where the hell am I going to put him? If he can, he'd go down to $4 so he can make $5 and be his own boss and be a little more local, and not work 3,000 hours. But he's not going down from $450 to $250 or $300. He's not taking that much of a cut until his kids are out of college, which is a good 6 years from now.
I mean, Max, couldn't he see that his firm was sticking it to him?
At $250?
At $450.
He does say that. He said the firm is sticking it to him. But they came up with some other things. He has contingency this if they sell. This is what happens with that. So he sucked it up and he makes his 450. I would suggest, Scott, I wouldn't suggest that for you.
Oh, I've been around. I see when people are trying to stick it to me, Max.
That's right.
Hey, Max,
Scott,
quick question. Do you find since COVID that geographically things have changed? That people are willing to look at in other areas because they are working remote?
Yes.
Mhm.
Yes. Yes, definitely, and no, definitely. Well, the no comes from, everybody who's selling. One question, one of the first questions they ask is, can you take over my office? Because people are used to coming here, so I'd like you to take over my office. And nobody wants to do that anymore. I shouldn't say nobody. I got a nice $1 million plus practice in the city. But there's a lease situation where he can't leave the lease. Nobody wants it. Nobody of value wants it. One of the 35-year-old kind of guys would have done it, but firms don't want. What do I need a second office in the city? I mean, all my city people are remote. I don't need that rent load. I don't need the office is not as good as I'd like. Rents are coming down 40% in the city, so why should I pay the rent that he negotiated 3 or 4 years ago? So that deal cannot happen. The owners decided to take that practice and grow it. So as his lease comes, and he's young enough to do that, when his lease expires, he can then make a deal. So location has become a factor. I got $5 million firms where 3 people come into the office now. It's really weird. And other $5 million firms where 80% of the people come in.
Is it only CPA firms you deal with?
Yes. I guess, and some EAs, and occasionally a lawyer with a tax practice.
And Max, for those that don't know you, I think most of the accountants know who you are and know what your company does. Tell us a little bit about your company and really how much business you guys do and where you see your growth in your company.
We're based, our office is in Melville. We handle New York. I handle New York up to Putnam. We handle New Jersey. We handle the greater Philadelphia area in Pennsylvania. We handle Northern Virginia and Washington, D.C. and all of Maryland. We also do Connecticut, all of Connecticut, half of Massachusetts, up to Worcester, all of Rhode Island, and the tip of New Hampshire, where it's really part of Boston. Our growth comes from a network of people that have now, at this point, have known us. So we have been calling and mailing every accountant in this area for the last umpteen years. And it's funny. Sometimes I go to visit an accountant and he's got, and I've never spoken to him before now, and he's got letters from the last 10 years, which he shows me. And we write them twice a year, so that's a lot of letters. often, and people know people, and it's a lot of word of mouth. I always like the NICPAP convention. That's been a very friendly and good place to say hello to people. But now it's virtual, so no more convention.
Max, if
So-
you need an introduction there, I'm on the board, so we can work
Okay.
something out.
All right.
Max, good morning. I'm Michael Dixon.
Pleased to meet you.
What kind of down payment is typically looked for in these kind of deals? I mean, the few deals I came across as a buyer are usually some kind of astronomical down payment, which I don't
Well,
blame.
that wasn't for me. If it were, we don't believe in astronomical down payments. Where's your firm?
I'm in Holbrook, right by
Oh,
McGrath.
So the down payment, are you a sole practitioner?
Yes.
Okay, so if you bought a $250,000 practice, then you might put up $75,000. And when you put it up, it's not a down payment, it's an advance payment. So if you're gonna pay him 20% of collections for 6 years, so you figure 50,000 a year, you put up 75,000, it's either gonna be applied against the first year or the first 2 years. And it's a sign you have some money. So you don't want someone buying your practice who doesn't have money, but the practice still is at total risk, because if you can't handle the clients, or the clients aren't there, or the clients were restaurants, and so they're just not going to be there now, then you don't pay. A good deal locks the two parties together. They should have enough time to meet each other and know the other person is competent. You pay a little bit more than a big firm would, because you're a small guy, but you pay on collections, which you could afford to do, and that works fine. No, there shouldn't be. If there's a tremendous amount of, if it's a $250,000 practice and you put up 150, I mean, how does that make any sense?
Absolutely. Now,
So we don't do that.
and how do the
Do people
multiples?
want all cash? Who wouldn't?
Right, everyone wants that.
They want all cash and capital gains, but I haven't done a capital gains deal this year or last year. I'm not saying we wouldn't do a capital gains deal. If you have, you could lower the multiple substantially and end up with a capital gains deal, but we only do collection deals. And that's the sensible way to do it.
Right, now how do the multiples change or
Ooh,
vary?
I lost volume.
How do the multiples change?
No,
Did you hear
how do they vary from a heavy tax practice versus a heavy, let's say, audit practice?
Wait a second, I can't hear, so something's wrong on my phone.
Well, if you told him to wait a second, you had to hear he was talking.
Why am I not hearing?
I don't know. Can you hear us now?
I have lost volume. I can barely hear you. And it's been clear all along.
Can anyone else pick up on that question?
Maybe
Okay,
put
What was the
speaker.
question?
Go on.
Repeat the question.
How does the multiple vary from let's say, a tax practice versus a heavy audit practice, for instance?
Michael, the audit practice tends to be more desirable if you have good staff and good people. Tax practice tends to be a little bit less desirable, depending on your paper lists, what your average 1040 look like. There's a lot of factors that go into a multiple.
I haven't had a difference in tax or audit or accounting in the last 5 or 10 years.
Well, would you agree, Max, that if you've got,
I totally agree, and that's true. But that's true for any. If you can run a tax practice and the partner doesn't touch it and gives it a once over, that becomes real valuable. But it's if you have staff to do it, and the rates and you're making your money on the staff, then yeah, it's a more valuable practice for you to buy. Absolutely, you're right.
Well, also an audit practice or a practice concentrated in audit is most likely merging to a larger firm as opposed to a smaller firm.
Absolutely.
Many smaller firms have given up the audits. They also don't have the people, the staff resources to handle audits in today's environment.
I think you would agree that the specialty is what makes your practice valuable. If you're a specialty at business val, if you have a specialty at bankruptcy, if you have a specialty in something, that your practice becomes much more valuable than just a normal write-up 1040 practice.
Craig, you picked profitable specialties, and
Correct, absolutely.
and that's correct. If you specialize, I had a firm come to me and they specialized in restaurants. They had a very good, efficient system for restaurants, and they were doing about 2 million too. And now they're doing about 800,000. So they were not a good, even though they were a specialty. Actually, they were a profitable specialty, not one you would want because it was all.
Those are the guys. Those are the guys you want to buy about 6 months from now at a discount, because in 2 or 3 years they'll be worth a lot of money.
What do you think that?
Well, I think restaurants will come back in 2 to 3 years, and if you've got a process and a skilled staff, I think you're in great shape.
Yeah, this poor guy. The restaurants are out of business. The owner, there were little restaurants, so the little guys are out of business, and he let go all his staff. And I'm sure he's going to let go his office space because he'll have no infrastructure left, and he'll retire. He'll join the priesthood. Yeah.
All right.
The restaurant industry will come back.
Yep. Does anyone else have any questions at all? Anything to add? We are planning some events coming up. Hopefully a charitable event or something about charity. And we continue to provide you up-to-date information as we have it, as the industries are all changing. And will continue to change with the current elections. And very much appreciate your membership and joining LAFPN. Right now, it's a very nominal fee of $200. You can just apply right online at lafpn.org. And as part of your membership, we'll introduce you to other professionals that you would like to have. And we hope to provide you the resources that you need to expand your practice. So with no further ado, I wish you goodbye unless there's any other questions.
Thank you, Neil, for the invite.
Thank you.
Thanks, Neil.
Thank you.
Max,
Okay.
thank you for the great
Thanks, Neil.
Yes, Max, thank you so much.
Max was great. Thank you.